Is this one of the most fascinating deep dives I've read this year? An investigation into RDCP, a British serial acquirer that turned a £2 million investment into £400 million in revenue by buying over 30 businesses. I'm joined today by Alex from Roll Up Europe, and he'll unpack how a young couple built this HoldCo from scratch, the playbook behind their deals, the wins, the failures, and what their story tells us about the future of SME roll-ups in the UK and beyond. Alex, you've done a deep dive into their story, and I've had the chance to speak with them too. So let me ask you this. In your view, what truly sets Sameer and Iryna apart, and what makes them special as operators, investors, and business builders?
Yeah, Mick, first of all, it's a pleasure to be on this podcast. I think when you read about RDCP, when you don't know which country it is, you would think it's in America because you've got two immigrants from other countries that have come into this major economy that had a couple of years experience working in a bank, and then all of a sudden they try to raise money and they fail at that, and then they go and buy some nursing homes, and that's really hard, and boom, 10 years later they end up with a business that's producing £300 million in revenue, 30 million in EBITDA. Given all the negativity that you read about the UK and Europe in general, you do not think it's possible, right? Surely they must have had some rich parents, sure they must have had a lot of institutional equity, but no, it all started with a 2 million equity piece, and they've just grown. And for me, that story was so incredible that I just said, listen, I have to profile that.
Where did you first hear about them yourself?
From the readers, because we have a lot of UK readers. It's the biggest part of our audience, and the RDCP's name just kept coming up as an example of a very inventive and creative couple that have been buying SMEs up and down the UK.
And personally, what surprised you most during your research when going through all this?
I think what surprised me is that it's very unusual to see holdcos like that have a very thin equity piece. It's not uncommon at all in the US where you have the SBA loans, but those tend to come with guarantees and they're not available in Europe. And in the case of RDCP, they've built this business without having central financing, so they don't have personal guarantees, they don't have group guarantees. It's all been done on a deal-by-deal basis. And I think just creating that scale over a relatively short period of time is extremely uncommon.
And if you did this research, what do you think? How does their banking background influence the way they operate RDCP?
I think it influenced in a very direct manner because they met just over a decade ago whilst working in debt capital markets. At the time, there was a lot of transactional activity in nursing homes. And I think understanding how to leverage an asset, understanding the different instruments, different types of asset-backed financing has been crucial. And, without that, I think they would have struggled to get anywhere near close to the level that they're at today.
And why do you think Sameer and Iryna turned down institutional capital? Was it about control, wealth creation, or maybe something else?
Yeah, well, you had them on the podcast, so I guess I have to ask them. But I guess at the start, and Sameer spoke at an event that we did for Roll Up Europe a few months ago. At the time, 10 years ago, nobody believed in them. So it was a case of, hey, you've got two kids, immigrants, in their 20s, no experience of running businesses. And I think they did a tour. They went to Dubai and people had just said, look, we're not interested. So at the time, it was just that the market didn't want them. But I think as time went by and they built this formidable cash flow generating kind of portfolio of properties, they got used to the freedom and the flexibility. And I think having investors having different types of requirements would be difficult at this point and even unnecessary.
I actually know this answer as well because you said it's right. They were on the podcast. I think one thing there is risk. They could obviously get a much cheaper debt from one provider to cover all their needs, but it's better for them. I don't know the exact numbers, maybe 40, 50 different providers, even though it's higher, but it's more diversified. And that's probably the reason they're doing this. What are the biggest philosophical differences between building a holdco like RDCP versus maybe launching a fund?
Yeah, sure. There's actually very different things. A fund typically has a mandate, so sectors you're allowed to invest in and not, has a clock, so you need to exit after a certain point in time, and then you have outside investors. Whereas a holdco like RDCP is industry agnostic. I mean, they've invested in all kinds of companies, usually asset rich, but that's probably the only thing they have in common. It's permanent and it's also highly personal. So there's no pressure to deploy capital on schedule. They can wait for the right time. And, that freedom, in my opinion, changes everything from deal selection all the way to how they operate those companies.
Now, talking a little bit about deal structure and capital efficiency, how RDCP engineered deals like SOS wholesale and mastered asset-backed lending, and what has been the timeline of the deals and the industries they pursue, and maybe why you think they decided to choose those industries in the first place? Hi friends, Brandon and Spacebar Studios are my go-to team for demand generation. They are offering a special offer to HoldCo Builders followers, a free 90-day growth roadmap for your business. Get 2 to 3 concrete steps you can take today to grow your demand generation engine. Head over to spacebarstudios.co to claim your growth roadmap, as there is limited availability. First come, first served. Now, back to the show.
Yeah, I think RDCP's playbook blends two overarching principles. Firstly, they go after industries which are very stable. So like engineering firms, nursing homes, and wholesale businesses, all of that is very important. And then on the other hand, they use industries which are, they've selected industries which are very asset rich. So they come with warehouses, they come with offices, they come with real estate, they come with receivables. So clearly you can raise a lot of financing against those assets.
Alex, now the exciting part and the deals part. RDCP acquired SOS Wholesale with just £1 million equity. What can we learn from their use of vendor loans and invoice discounting? And also, what was the deal size for SOS Wholesale in the first place?
Yeah, I mean, that deal was crazy, right? It's a masterclass both in deal structuring and the usage of asset-backed M&A. As you said, the business had a top line of about £50 million. It has since come back down a little bit, but the business remains solidly profitable. And the interesting part is RDCP paid about £14 million in enterprise value. The equity value of the business was about $10 million because they had $4 million of cash on the balance sheet. But out of the 10, it injected only $1 million of equity, which is 10% of the total equity value. And the rest was financed in a creative way. So there was a vendor loan of just over £2 million, essentially the money that the seller agreed to loan to RDCP. And there were also over 7 million, almost 8 million worth of pounds of various debt instruments. There was invoice financing, there was a sort of a term loan, and big part of it was the fact that the wholesale businesses carry a lot of receivables, which can be secured.
Alex, you're the numbers and the finance guy. How does RDCP's financing model differ from traditional PE-backed serial acquirers?
Yeah, in a couple of ways. Firstly, PE firms rely on committed capital from LPs. So there's a certain timeline that they need to deploy the money, a certain time that they need to exit. Usually there's a 10-year time frame. And, which is the case today. If you have deals that you need to exit, but the market isn't great, then you are forced to take a haircut on your investment, which is not the case for holdcos like RDCP, which do not have such investment horizons. The second thing, oftentimes private equity do much bigger deals. So they raise private credit typically from the funds, which tends to be expensive. Whereas in the case of RDCP, it is focusing on smaller deals, and they've mostly raised money from banks and specialty finance companies. And maybe the final part is private equity firms tend to segregate investments from the various companies. So you may have a single fund, but you can't freely move the cash between investments necessarily. Whereas for RDCP, it's the secret sauce. It's the fact that excess cash has been moved around and used to finance various investments in the portfolio.
You met Sameer and you met Iryna. They were on one of your events on the panel. What is the RDCP's edge in navigating the UK's lower middle market asset financing landscape?
They have the knowledge, they have the respect of the lenders. They've borrowed from firms like Hitachi, Barclays, AIB, which are all household names. I think Sameer and Iryna are excellent at crafting bespoke capital stacks on a deal-by-deal basis, which gives them access to acquisitions that others cannot touch because, it's a difficult capital structure or the asset that is maybe slightly distressed. So I would say their edge is the financial engineering without having institutional backing.
Now, talking a little bit about the case studies and outcomes, let's take the CARE, the SOS, and the Berkshire, if I pronounce this correctly. Lessons from those deal outcomes. What about the failure one, the Berkshire? How much... what happened there? Could you give us an overview and maybe what are some of the lessons?
Yeah. So this is an interesting one because in the article, which I put together based on public disclosure, to me, it seemed like a clear case of a failure. But then I read the 2024 annual report, and actually there was a little bit more nuance to that deal. So it's not as bad as it maybe looks from the outside. So Berkshire was a distressed roll-up from the very start, right? It had over 40 million in liabilities against just 5 million in EBITDA. It was over-levered. It had a pension fund deficit. And RDCP came to it, I think, twice. And basically, it was about injecting some capital into the group in the form of working capital line. And I think they failed to do it and they lost control of the group. So you could have ended the story there. Maybe this was a write-off. But actually, reading the annual report, I discovered that what happened is that RDCP were able to carve out two of Pexion's subsidiaries, CC Electronics and Honol Precision, and those companies are now part of RDCP Group.
Now, and home care. So what made the care home strategy bankable, and how did they leverage it to fund other ventures?
So care homes are great because they offer steady cash flow. It's not like the people that stay at care homes are going to go anywhere. And secondly, is the asset backing, right? It's the real estate that obviously can be leveraged, and the banks love that. And I think going into such an institutional segment, which is very well known in the UK because there's a lot of care homes, gave them the credibility and the financial muscle early on. And ultimately, the care business, home care, the nursing home business was so profitable that it funneled fees and dividends up to the group, and it became the first internal capital source.
Why do you think SOS Wholesale was a win for RDCP, and what did they get right when doing this one?
I think they chose a business which was very stable. So wholesale distribution of food and beverage is a very stable business that doesn't fluctuate up and down with the economic cycle because people need that all the time. They didn't need that much capital. So this was partly a function of maybe the business running on thin margins, but also the fact that you basically had a contrast between the amount of collateral that the business had and the amount of cash that the business was actually producing. And if you could get comfortable around your ability to service the debt, you could actually put a lot of debt on that business. And I think the final part is, it's a business that's producing something like 100% of cash flow conversion, so it's good cash, but also RDCP have been using this cash to pay down the debt. So it's not like they put a lot of leverage and they kept it there, but they've been deleveraging and creating value.
Now, it's a bit loaded question, but what broader lessons can other HoldCo builders and serial acquirers take away from, number one, this home care deals, and number two, this Pexion deal and the structure and all that? Guys, if you own a business, you're probably making mistakes left and right, mistakes that cost you time and money. Rand Larson from Scalebath has built a community of other business owners who've already made those mistakes and will share their experiences to help you avoid them. Each group is small, just 7 operators with similar business models and revenue. You meet once a month on Zoom to get direct feedback on your biggest challenges. So to do all that, go to joinscalebath.com and schedule a call with Rand himself. Now, back to the show.
I think number one, if you don't have a big institutional backer, like a family office or a private equity firm, you need to be very good at sourcing debt. You need to be very good at structuring various debt instruments, understanding how invoice financing work, how mortgages work. Otherwise, you'll just forever be stuck in doing really small deals with your equity. So that's number one. And number two, I think you need to be open-minded and also creative. And if you see that one business is performing really well and is producing a lot of excess cash, then you need to find a way to dynamically deploy this cash in another business. And that's how you build it step by step.
Now, when it comes to strategic ambition and legacy, I know Sameer, not a dream board, but he will see, he can see his net worth today and Warren Buffett's net worth on his age, and they're on the same place pretty much. So what is your thought of them becoming this British Berkshire Hathaway? Is it realistic considering their young age, or it's more like a marketing stunt for them?
I think, first of all, aligning yourself with the Berkshire brand and marketing yourself as the British Berkshire Hathaway has very clear advantage, which is it helps you anchor conversations with sellers and lenders. Storytelling is a huge part of HoldCo building, and if you can explain to people that, listen, I'm going to be like these guys, it immediately helps you install some credibility. I think when it comes down to the actual operating model, I would compare RDCP less to Berkshire Hathaway and more to the US HoldCos that I met at a conference a couple of weeks ago. Those are highly leveraged, opportunistic, and fiercely independent money machines.
Do you think their current structure, correct me if I'm wrong, heavily SPV-based and bank leveraged, can evolve into a more permanent capital vehicle over time?
Yeah, I think they're definitely on the path. And actually, if you read their annual report, and I think Sameer also likes to talk about it, they're definitely moving to a structure that's more centralized. And I would say in order to transition to a more like Swedish style or Canadian style HoldCo, probably two things need to happen. One is the degree of centralization and shared services needs to improve. And I think this idea of centralizing finance, operations, IT, HR is a very good idea because those are just costs that don't need to sit within the portfolio companies. And the second one, I think in order to be considered a high-performance HoldCo, you need to demonstrate the internal capital flywheel. It's all about ROIC. And I think it's about creating internal market of capital where you say, hey, I'm producing this amount of free cash flow and all that free cash flow is going to be reinvested at rates of return significantly in excess of the weighted average cost of capital. And that's something that I think we have yet to see from RDCP.
Alex, you've done so many researches, 100 plus of those with Pavel. You've seen different industries, different structures, different models. If you can say, what does RDCP need to change or maybe improve to actually become British most dominant SME HoldCo based on what you've seen on your previous researches?
I think as the business naturally evolves, I think a more institutional structure will be built around it where maybe there is some central financing. I know that obviously RDCP haven't had the best experience with group guarantees, but I think at some point creating an acquisition facility which powers all their acquisitions has some benefits. And secondly, I think we just need to see more numbers on return on invested capital. I'm sure the numbers are very good, but I think understanding how the different asset classes actually compare and what the business is returning would potentially unlock more financing and more deal opportunities for them.
What did you personally learn the most from this research? Obviously, one thing is obvious, the belief that one can just do things like this is a true power couple, Sameer and Iryna. Doing that on such a young age, this is one thing, obviously. But what else? What else did you learn from this research?
The most inspiring part is the self-belief. You had two immigrants in the UK in the middle of austerity, no funding, no reputation, just bare conviction. It's not a lot to start with, right? Mm-hmm. So two immigrants in a difficult economy, what do? They go on a roadshow to Dubai trying to raise funding for a care home roll-up. Crazy idea, niche, right? So it didn't work out. They went ahead and did the deal anyway. And then they did the second deal and then did a third deal. So having self-belief and having conviction is important. And the second thing is they've had a few setbacks. We talked about the Paxion bankruptcy, but that has not dented their optimism, has not dented their ambition. The business has grown every single year. And I think that's what I, as a HoldCo builder, and that's what every other HoldCo builder out there should understand. Building a HoldCo is a very long and lonely process because unless you're willing to be significantly diluted, you have to just take time. And that's what RDCP have done. And, 10 years they had nothing. And today they have a business producing, 300 million pounds worth of revenues.
You said building HoldCo is long and lonely. Yes, it's long, but it doesn't need to be lonely. Thanks a lot for doing this. And we'll post another one next week. Thanks, Alex.
Pleasure was mine.